Welcome to Investing with Danelle. I invest small amounts of money over a minimum 10-year horizon using an investment portfolio I started in 2022 with approximately $5,000. Information sourced for most of the stock study information, Fidelity Investments, and the December 2nd, 2024 stock study sheet from Edward Jones. A disclaimer, this is not an endorsement of Edward Jones. I'm not a fiduciary. My emphasis is stock study. Follow me on Substack and LinkedIn for blog and video post updates. Here's the stock study schedule for 2025. January 2025, we're studying communication services, and I will explain the percentages in the Patreon exclusive. Consider joining me on Patreon. But first, the portfolio balance. As of January the 1st, 2025, $11,539, a decrease in value. Asset allocation. 55% domestic stocks, 3% foreign stock, 42% bonds. The current asset allocation of your selected accounts most closely resemble a growth with income mix. Let's begin the stock study. First company, Comcast, symbol CMCSA. This is a price chart going back to 1980. There is a dip in 2024. Earnings per share, $3.71. That is quite a return. You take the earnings per share and divide it by the current stock price. And it's almost a 10% return. PE ratio, that has to do with profits to earnings, is 10.07. That is a very good PE ratio. That means there's a relatively low amount of debt. Anything under 20% is a very good PE ratio. You don't want the PE ratio to be too low, particularly if you're looking at a starter company. That could mean trouble, potentially, not always. Here's performance of Comcast. The 10-year rate is 29.41%. The last year, the stock has been down 14.41%. In my opinion, if I looked at this, I would think that this was a good buying opportunity because of the dip in price. Also, I do understand the concept of this company. Disney, symbol DIS. Here's a price chart going back to 1975. There's a dip. If you look, you'll see the price got up to $190, and then there's been a recent dip. The price was at $111.35. This appears to be dated in December 2024. Earnings per share is $2.79. And then the PE ratio is 40.79. That is greater than 20%. That means they have quite a bit of debt. I will say almost 50% of their earnings. This would make sense because there is a really narrow profit margin in entertainment in general. That makes sense. Plus, they have to spend a lot of money coming up with new things and new shows and partnerships. Here's information going back to 1975, before 1975. With Disney, if you have children and you're trying to teach them about the stock market, Disney is a good company to buy because most children understand Disney. I remember reading that somewhere. I don't remember what book it was. Warren Buffett says to buy things you understand. Next stock, Meta Platform, symbol META. Stock prices going as far back as July 2014. The price has gone up. You look at 2023 and look how that price has gone up. I mean, if you looked at buy low and sell high, if I had a lot of this stock, I would be trying to sell a little bit because that price has gone up. Meta Platform price, December the 31st, 2024, $585.51. Earnings per share is $21.48 per share, and the PE ratio is 27.53%. That's a decent PE ratio. Decent PE ratio. I mean, the earnings per share is okay. If you looked at this, well, I don't know if I would consider this good earnings per share. It's less than 5% definitely. And the price is really high. Ten-year return, look at this 10-year return, 650.46%. 1-year return plus 65.42. This really, I mean, if I had bought this way back in 2014, it went up, then it dipped right before 2023, then it went up. And I was trying to liquidate some of my portfolio. This would be a good thing to liquidate a little bit. Next stock, Alphabet Class A, symbol GOOGL. Price on, let's see, the price is $189.43. What is in this information is from? This information is as of January the 2nd, 2025. Back to 2026, the price has gone up. I mean, if I was looking at this, I wouldn't necessarily be buying this individual, but certainly a mutual fund with this would be great, especially if they got it back 2006. You think about it, if you bought if you bought mutual fund in 2006 that had Google Class A, you would be making quite a bit of money. It is some earnings per share. I think that this one, you're making more money from the price increase compared to the dividends. I mean, the dividends help. And here's some information about Google Class A. I think most people know the things that Google does: Gmail, Google Drive, Google Maps, Google Photos, Google Play, Search, and YouTube. The next stock, because this is also Google, but this is Class C, symbol GOOG. I don't have a clear idea why they have two different classes, but I do notice that both Fidelity Trend Fund, symbol FTRNX, and Fidelity 500 Index Fund, symbol FXAIX. They both have quite a bit of Google in their top 10 holdings. So this is Class C. The prices is also way up there. Yeah, I mean, that's pretty much Google Class A and Google Class C. For myself, I would not buy this right now because the price is so high. Only way I would buy it would be within a mutual fund that has holdings. Recent purchases and dividends, I decided to buy Comcast because of the price and profit to earning ratio. That's the PE ratio. Disney was well priced. The profit to earnings ratio is higher than Comcast. Here's my recent purchases. Also, keep in mind, I'm still getting dividends from stocks I already have. And in that case, I go ahead and do a small purchase, in most cases, based on funds available. Here's my recent purchases: Federal Express, Prologis. This is all dividend reinvestment. I mentioned I bought Comcast. And here's dividends from both Federal Express and Prologis. Prologis is a REIT, real estate investment trust. I have lots of videos on real estate investment trusts. And the January 2025 investment portfolio is complete. Go to the About section of my YouTube channel to learn more about where I am on social media. Remember to subscribe, like, and share, and click the all notification bell. Until next time, enjoy the journey.